Hello. Testing. Can you guys hear and see me? Okay, if you can you just type yes in the chat box? Thank you very much. Now, there's a bit of issue with my platform today. It does looks weird to me because the functions that I normally have seems to be missing. Anyway, hope you can see my screen right now. Let me see. Okay, if you can see my screen, that's good. Now I will have to toggle between this screen and the chat, so I can't see the chat from where I am right now. So it's a bit of a nuisance. Okay, guys, and to get started, let's get the ball rolling. And again, this is something that we need to go through. Disclaimer. Now, this presentation is, of course, not an offer to buy or sell any kind of securities, be it futures, options, CFDs, foreign exchange, or even cryptocurrencies. And of course, you guys would have to understand the trading of any kind of leverage products do carry the element of risk. So do understand your own risk profile before attempting to trade any kind of leverage products. And of course, there will be a segment in which I'll be sharing you my views of the various markets. And do note that those are my views and have got nothing to do with my company, Traders Academy International Private Limited. And therefore, we will not be responsible for any action that you may take as a result of attending this presentation. Now, the first thing that came out this week itself was the China GDP numbers. It was definitely not a good number, but based on what we were expecting, the market was expecting terrible numbers. They were expecting on a quarter-to-quarter basis for Q4 of last year, negative 0.8%. It came out to be zero, which is like no growth and no losses. So that was good on hindsight, but basically we can see that the GDP numbers for China has been slowing down remarkably since the first quarter of 2021. So we have seen that this is a downward trend, and it's likely to stay down for a while until activity pick up in China. Okay, on a year-to-year basis, also for Q4 of 2022, market was expecting up 1.8% for the year itself, so it came up 2.9. So based on the market negative outlook, it came in to be a lot more better, much better than the market was expecting. So on balance, it was not that bad a number, but overall, you can see the whole of 2022, China GDP only grew by 2.9%, which is a far cry from what it used to do, northward of 6%. So we can see that the Chinese economy has taken a major hit since the COVID lockdown. Okay, and of course, retail sales is also expected to be bad. The market was expecting a terrible number of negative 7.8%. It came in not so bad, but still negative at negative 1.8%. So again, this is where we were expecting. The market was expecting a terrible number, but it didn't come out to be that bad. Okay, but it's still negative. So we can see that retail sales in China has not rebounded significantly yet. We need this number to go beyond the 0% mark, and ideally, northward of 2-3%. Okay, so we have to see those numbers as we go on forward for the year 2023. Then, of course, we have the labor numbers from UK. We have the claimant count change. Market did not give us any kind of estimate, but it came in to be lower than expected. So the number of people claiming benefits for being jobless has actually gone down to 19.7 thousand. So it was not that bad, okay, compared to the month of November, which was more than 30,000 people claiming benefits. Okay, so based on this count, it does seem that the labor market in the UK is not as bad as market was expecting. Okay, and then of course unemployment rate has stabilized. It has plateaued at 3.7%, and now 3.7% is not a bad number considering it's a very mature and developed markets. Anything that's around 3% is considered as full employment. So you can see unemployment rate in the UK is only slightly worse off than the theoretical 3%. So can we say that the job market is bad in the UK? I wouldn't say so, because you see, it could have been worse. Because when you look back, especially the claimant count at the beginning of 2022, you can see that they were all negative. That means that nobody claims jobless benefit, but you can see these numbers has been creeping up since November of last year. Okay, and this is of course impacted by the fact that interest rate has been going up, and central banks around the world has been trying very hard to kill off demand, of which they must kill off employment. So we are seeing the ill effect of high inflation and high interest rates. Okay, Excuse me. Now, the harmonized index of consumer prices, which is the inflation number for Germany on a regularized basis, we can see that it peaks at 11.6% in October last year, and it has been coming down dramatically based very much based on lower energy prices, in particularly natural gas. You can see prices for Germany itself in terms of inflation has actually seen peak inflation, which is something that we also saw very much so in the US, whereby peak inflation actually was in June of last year. So since then, the market has been, the numbers that are coming in regards to inflation has actually seen remarkable improvement. So when you say that, have we won against the fight against high inflation? It does look like the case if we look at the data, okay? But if you ask any of the Americans or the BRICS whether they do feel prices has come off, I don't think we're going to get the same similar answer like what the data is showing us. So we got to take the data that we've seen with a pinch of salt, okay? Now, on the core inflation for Canada, we also see similar pattern, very, very similar to what we saw in the US CPI numbers. The consumer price index minus energy and food prices has seen further decline in Canada, back down to 5.4% for the month of December. So this is actually the best number since the start of the war in Ukraine. And of course, if you have to take this number and bang it, can you bang these numbers? Ask any Canadian, I don't think they will share the same sentiment that prices are coming down. Okay, so we have to watch these numbers very, very closely. Okay, over in Japan, we can see that the BOJ, which is the Bank of Japan, interest rate remains unchanged at negative 0.1%, which is the only major central banks in the world still maintaining negative interest rate posture, where the rest of the world has actually been hiking rates very aggressively, led by the Federal Reserve. Okay, so you can see that there's no change over here. Now, of course, what happens this week itself when the whole market is waiting for the Bank of Japan to give us more sign that they are going to allow yield on the Japanese government bonds to rise beyond 0.5%, which was a surprise the last time they did it, which is last month. And this time around, they actually stand pat and not do anything on the interest rate front. And you can see the market went into a spasm. Dollar yen actually rebounded, and then we can see that the Nikkei 225 actually was going down. And that was how the market reacted very, very violently. So we do have to watch how the market behaves going forward, because the Bank of Japan is not giving us any hint as to what they want to do next after surprising the market last month, okay? Over in the UK, consumer price index continued to slide from a peak of 11.1%. Now it is still double digit at 10.5%. So again, this is slightly lower than what the market was expecting at 10.6%. Again, we can see a slowing down from peak inflation, but I think the UK is still under very severe inflationary pressure because CPI numbers is still in the double digit, okay? Then consumer price index, this is something that we again confirm what we already saw in the CPI number, which is the consumer price index. The producer price index actually was trading way, way, way low. In fact, it hit the lowest it had ever seen for the whole of 2022 at 5.5%. Remember, at one stage it was 9.6% in the month of March, right after the war in Ukraine. So you can see, as far as producers concerned, prices has been coming down. Either they are not buying as aggressively, or the demand is not there. So basically, people look at this and say that, oh, inflation is more evident that inflation is coming down. But if you look on the flip side, it means that they are buying less. So it may not necessarily mean that there is less prices are coming down. It just show that demand is not there. So they have no need to buy more. So the producer are not stocking up. Okay, so this could be another way of looking at the same problem from another perspective. Retail sales is the dying one. Okay, this is the one that killed off the nascent rally that we saw this week. And why is it the case? Remember, back in November during Thanksgiving, we have a similar number at negative 0.6. Now, do remember, November Thanksgiving is a holiday season. Typically in November, leading to the Thanksgiving, retail sales typically were picked up. And then again, we have this month release of the December number. Now, December is Christmas. We have holidays. You know, those are both holiday season. we should not be seeing poor retail sales number, but here we have it. Okay, both in November and December, we are seeing negative number for retail sales. Now, we all know the US economy is made up of consumerism. So if Americans don't spend, the GDP is not going to expand. So this is going to give us a heads up as to what we can expect for the GDP going into Q1 of 2023. It is definitely going to be a lousy number. So based on all that we can see, yes, inflation may be coming off, but the consumers are all maxed out. They have maxed out their credit card, and interest rates are so high, they couldn't even afford to keep their houses. So we can see shelter prices has been coming down. We can see the demand has been coming down very evidently by the retail sales number we saw in November and December of 2022. So this is telling us American consumers are tired, they are fatigued, they have no money to spend because the stimulus check has stopped coming in. Okay, so there we have it. Going forward into 2023, we do expect slower economic growth. So can we say that the fear of inflation is definitely very, very much warranted? I would think so. Okay, if American consumers are finding fatigue, because interest rates are simply too high compared to where it was in 2021, definitely this is going to impact the GDP and, of course, going forward, the economic performance of the United States. Over in Australia on Thursday, we have the employment numbers. Employment change has actually gone down. No new jobs were created for the month of December. Actually, it was negative. More jobs were lost in December than being created. So the number was negative 14.6%. Market was expecting a positive 22.5. So you can see from positive 22,500 jobs to be created, we get a negative 14,600 jobs were lost instead. So this is definitely a lousy number. And we look at unemployment rate. Yes, it has seen no major change here. It remains at, okay, maybe I have not updated this chart here. Market was expecting 3.4, it came in 3.5. So we can see there's a notch up in terms of unemployment. So again, this is definitely not a good sign going forward towards the end of the year, okay? So you got to watch these numbers as we go forward. Over on Friday, we have Japanese consumer price index. You can see consumer price index in Japan has been climbing and climbing and climbing from a deflation number at the beginning of 2022. Now we can see inflation is at the highest it have ever been since the 2022. You can see the core CPI numbers, which is you take out energy and the food component, is at 3%. Whereas the CPI numbers is at 4%. This is the headline numbers. So as far as Japan is concerned, this is a big problem, okay? Because we have rising prices and we have not seen matching wage increases. This is going to put Japanese consumer on a back foot going forward, okay? So these are not good numbers. So we have China. The People's Republic Bank of China interest rates remains unchanged at 3.65. No surprise here, and there was no news as to whether they have allowed the reserve, the bank reserve, to actually increase. So on that front itself, there is no new impetus. So the market did not react very much based on this number, because this is all within expectation. Now, retail sales in the UK, we're again seeing very similar number. November, December, we see retail sales in the UK, because US and the UK have very similar culture. These are basically holiday season, and retail sales theoretically every year during this period of time should pick up. But this year we are seeing both United States and the United Kingdom retail sales actually were in a negative territory in November and December itself. So this is laying the we call it that the groundwork for lower economic growth going forward. Okay. Now, Canada retail sales is also seeing a plunge from positive in October, 1.4%. Of course, the number here does not include December, but again, we are seeing the same similar pattern here. November is Thanksgiving. Canada, United States, they have very similar culture and they celebrate the same holiday. And again, November was a terrible number. Market was expecting a really bad number, negative 0.5, but it came in negative 0.1. So it wasn't that bad, but it is still negative nonetheless. So the December number coming up next month is going to be, I think, foregone conclusion if you take United States retail sales as a guide, okay? Now, going forward in the coming week itself, we're going to have a lot of heavyweight numbers on Tuesday itself. Germany, we're going to expect the composite PMI, which is the Purchasers Management Index for the month of January. Remember, this is only a preliminary number. Market has a consensus as 48.9 compared to the previous at 49. So anything below 50 is contraction. So as far as this number is concerned, unless the number pop back up above 50, the Germany economy is still going to be in contraction because the PMI is in sub 50 numbers. For the manufacturing, it's even worse. Market was expecting 47.5, but this is a slight improvement if it come up to be exactly 47.5 because the previous numbers of 47.1. So this is way below the 50 marks, and it has a long way to go before it can climb back up again. So as for Eurozone itself, the entire Eurozone, for the composite PMI numbers, they're expecting 49. Again, deterioration from the previous number of 49.3. Services PMI, which is going to be heavy for UK because compared to Germany, UK is a very service-oriented economy. So services PMI is going to be the key. They expected no change at 49.9. Again, remember this number is below 50. So even the service sectors in the UK is also seeing contraction. So this can only be problematic going forward. On Wednesday, we have the CPI numbers coming up from New Zealand. They're expecting a climb down from 7.2% to 7.1%. Australia expecting the same number from quarter on quarter, Q4 of last year. They're expecting a climb down from 1.8% to 1.6%. Monthly basis, on the year-to-year basis, for the month of December, they expect a climb down from 7.3 to 7.2%. Canada also have interest rate decision. No, nothing has been forecasted. So the last number was 4.25% for from Canada. On the Thursday itself, on January 26th, we have durable goods. This is going to be a heavyweight numbers for the United States because the entire week itself, this is the only number beside the GDP numbers that's going to be also released at the same time at 9:30 p.m. Singapore time. Durable goods for the month of December, they expect improvement relative to the previous month of negative 2.1%. They expect the market to pop back up above positive to 0.1%. GDP on an annualized basis for Q4 2022, GDP in the US is expected to climb down a little bit from 3.2% to 3.1%. So we will have to see whether the revision is going to be upside or downside or constant. Okay, so non-defense spending, non-defense capital goods, which is part of the durable goods, excluding aircraft purchases, is going to be flat at 0%. Okay, this is not as good compared to the previous month of positive 0.2%, but again, it's quite flattish. So there you have it. For the economic numbers, we do have a heavy week going forward. This week itself, we also have something major other than the numbers that were released. We have on Thursday, the US Treasury, Secretary of the Treasury announcing the US debt ceiling has been hit. It means that they cannot borrow any more money unless Congress allows the ceiling to be raised. Okay, and every other year we have this same problem again and again for the last 20 over years. Every time they have hit the ceiling, the United States is a nation that has been spending beyond their means for decades, okay? And they do not have to pay the price because of their reserve dollar status, okay? But that may be coming to an end. And of course, recently we know the midterm election, as far as the Congress is concerned, there are two chambers in the Congress. We have the Senate and then we have the House of Representatives. And when Biden came into power, they were in control of both chambers of the Congress. But after the midterm election in November last year, we saw that the House of Representatives was lost to the opposition, the Republican Party. Okay, so now we have a new House, what we call it, House Speaker. Previously, it was Nancy Pelosi. Now there's this guy called Kevin McCarthy, and he has to go through 15 rounds of voting to be confirmed to be the House of Representatives, ironically from his own party members. 6 of his own party members has been obstructing the votes without giving him the all clearance to hold the baton to be the House of Representatives, we call it the House Speaker. So these 6 members, 6 Republicans, now is holding this new House Speaker, how would I say, he's been held ransom, because part of the agreement for them to agree to support him to be the House Speaker was that his term can only be one term. Okay, and if any one of the six opposing votes that give him the last clearance to be the House Speaker do not agree with his policy, they have the right to actually take him down. Okay, and now we have this debt ceiling, and of course the Republican and the White House, President Biden, he said that, look, there is no need to negotiation. There is no ground for negotiation. I'm not going to negotiate with you. You have to agree to lift, or what we call that, to raise the debt ceiling so that we can, the economy can continue to function. Okay, but the problem is this: Republicans do not necessarily going to give the Democrats a blank check this time, because the 6 opposing Republicans has already said they do not agree to increase or lift the debt ceiling. So that put the House Speaker in a very, very hard place, okay? Because on the one hand, he needs to agree to get the economy going. On the other hand, if he agrees to lift the debt ceiling, any one of these 6 members who oppose him is going to take him out. Okay, so there you have it. This time is very, very different. Unlike previous episode in which a U.S. debt ceiling has been hit, they always come to some kind of compromise, and eventually the debt ceiling will be raised. This time, I think something else is working, and it may not play out the same way. Okay, so we will have to watch. If the U.S. do not raise the debt ceiling, they cannot issue more treasuries. It means they cannot borrow anymore. So if they cannot borrow anymore, then obviously certain people working for the government will not be paid. Okay, because the public sector, the public sector's staff, okay, teachers may not get paid, firemen may not be paid, the soldiers may not be paid, because they cannot borrow anymore. So they will come to a point in time, I think, if this continue for far too long, when the Secretary of the Treasury run out of all her trickeries, eventually they will have to sit down and talk about how to resolve this situation. But I think, like I said, this time is very different. We will have to see how this thing plan out. And if we cannot get a resolution, it is all bad for the stock market. Okay, so there we have it. Let's go to the stock market and see if we can get some kind of resolution here. Okay, this guy cannot get, let me see if I can paste this for him. Hang on. Some of them are not able to get into the room itself. Let me send them the invitation link. Hopefully they can be there. Hang on with me. Okay, I've sent up 3 invitations. Hopefully they can come in and see and join us. Okay, now let me see. Okay, now I will go ahead and share my chart with you. Tell me you can see my trading view chart. Can you see? Can you type yes into the chat box so that I know that you can see them? Okay, guys, thank you very, very much. And now let's continue with the presentation. Like I said, today my screen looks really weird. I don't get the usual look and feel. Okay, based on the Dow Jones itself, this is the daily time frame. Okay. And we can see that the price has been falling from the get-go. The high traded for this month was 34,342.3, and we have seen that was on which day? Let me see, on last Friday. So beginning this week, we can see the price has been falling. Okay, and it was only starting to rebound towards the last few hours of trading on Friday. Now this is very, very suspicious here, and you see the market has been technically looking to come down. Okay, so this very weird movement on Friday. Let me show you the 1 hour time frame. The movement started to go up. You can see that the market started to reverse itself somewhere around midnight. Okay, so this late movement in equity prices on the to the upside, it suggests to me that somebody is trying to prevent the put option from paying out. Okay, because when you trade futures contracts, when you trade the equity index on the CME, you have this weekly option that expires on every Friday. So you can see that the market may be trying to avoid certain put options from going into positive territory. It means end up paying out. Okay, so the stage has been set in my mind that we may be seeing lower prices. And coming up next week, we have January 23rd. I have mentioned two dates. Okay, two dates of concern to me was January 16. Okay, but January 16 was Martin Luther King Jr. birthday. Okay, I forgot about that altogether, and the bad move that I saw that may come in did not happen. But again, you can see from that day onwards, although that day there's no market for the US, the following day on the 17th, the market did not go up. So you can see the high traded was last Friday. Okay, so this week itself, we can see market has been coming down from the get-go. At the opening bell, it has been coming down, and it only started to rebound towards the ending hours of Friday. Okay, so the next critical date to me is January 23rd, which is tomorrow. So if tomorrow something bad happened, I do not know what's going to be the catalyst. It could be the national debt. Okay, I have this sense that something bad is going to come out from the United States tomorrow. Okay, maybe there is going to be no resolution. What we've been hearing in the mainstream media is that Kevin McCarthy, the new Speaker of the House, is prepared to meet Biden to talk about how to resolve the debt ceiling. Okay, but he knows he cannot agree to lifting the debt ceiling because the 6 members of Congress from his own party is holding him ransom, that if you agree to lift the debt ceiling, they are going to vote him out. Okay, and obviously somebody who has just gotten the baton to be the House Speaker is definitely not going to risk it. So this is going to be a very, very interesting and very watch event. Okay, so like I say, things are different this time around. The House Speaker is not from the same party of as the White House, so there is going to be a lot of horse trading going forward. And this time around, the House Speaker may not be in a position to agree to lift the debt ceiling, and that could cause chaos going forward. So it could happen tomorrow, or it could happen anytime this month. We only have about another week more to go before the end of January, and the danger does increases as on each passing day. I am very, very bearish on equity markets in the States. Okay, do know my sentiment here. So over in the S&P 500, we also saw something very, very different. This time around, the counter trend rally that we saw on Friday was not led by the Dow Jones. Surprise here, it was led by Nasdaq. Okay, Nasdaq was the weakest link among the 3 major equity index in the States. And this time around on Friday, we saw that the market went up a lot more in the Nasdaq, followed by the S&P 500. The one that hardly budged, okay, it did rebound, but it wasn't not in the same degree like in the Dow Jones. Okay, so you can see that the market right now is playing a different kind of game. So you can see market come down. High traded was on last Friday, 4,015. No, so this is actually traded at the beginning of this week. Okay, there's a marginal high, and the market immediately come back down. So again, this is very, very suspicious to me. Okay, so yes, the rebound has been very aggressive because it has pulled back more than 50% of its entire fall from 4,015. So based on this number, it does look a little bit weird to me. So be cautious about maybe the market will attempt to even take out the 4,015 in early part of Monday. Okay, tomorrow's trading. Do watch out for the move here. Like I said, the big move that caused this market to rebound on Friday was led not much by the Dow Jones, but by the Nasdaq 100. You can see the rebound is now almost challenging the high for the week, which was last traded on Wednesday this week. Okay, at 11,690. So something is moving here, and we have to be on our toes to see what is going to happen. Okay, now let me see if you guys have any question for me. Okay, it looks like you guys are happy with no question so far. Let's continue. Now over in, I want to cover the Russell as well. Russell 2000, as we all know, is the small cap index. Now I have not been covering this index for quite a while, but it seems to be also having very large move of late. Okay, so you can see that as far as we are concerned, the November came the January numbers came very close to take out the last November high. Yes, already taken out the December high, but did not quite take out the last November high of 1,905. Okay, so we can see the price is now rebounding, and based on the rebound, it does look like it has a potential to actually go higher, maybe to as high as 2,000. Okay, so we have to watch this Russell very closely, because it's behaving very different from the rest of the other equity markets, even the Dow Jones. So it does look like there is a lot of buying going on in the Russell 2000. Okay, so this is definitely, for a while below my radar. So it has been slowly creeping up, and it does looks very bullish as far as I can see here. Okay, so not sure what's happening here, but we have to watch. Now, is there nothing else? I will move on to Asia equities. Do you guys have any question for me before we move on to Asia? Okay, looks like you guys are quite happy, yeah. Now, Asia. On the Hang Seng Index itself, we can see that Hang Seng has been charging away. Now it is at the highest this month, 22,051. Now it's getting very close to the last June high of 22,449, as well as the last April high of 22,523. So again, based on this projection, it does look like there is still a little bit left in the tank for Hong Kong equity market. The market may actually target 22,118, which is my original target. But be very careful. We may have a strong opening in Hong Kong tomorrow, but how it closes is going to be key to me. Or if it's not on Monday, I want to see a reversal happening on Tuesday. So I am thinking this Hang Seng market is looking to be very toppish to me, okay, because it has run ahead of itself relative to what we are seeing in US equity markets. So be very careful chasing this Hong Kong market ever higher beyond 22,000. I do expect the market to pick either tomorrow or the day after. Okay, so be very careful. Now, over in the Shanghai Composite Index, we are also seeing a renewed effort to charge higher. You can see the Shanghai Composite Index actually closed near the high of the entire week itself. In fact, for the matter, it's closing very near the high of the month. Okay, although we have one more week to go before the end of January, the high traded this week is 3,267.06. Now, if this market can continue to charge higher, especially if it take out 3,308.35, then something else is moving, because then I will have to eliminate this pink color box and only show the very positive, very bullish market here. Okay, so do watch out. The key level to watch will be 3,308.35. Okay. Over in the Nikkei, we can see Nikkei prices has also rebounded very aggressively, but you can see that this is on Wednesday. What happened on Wednesday? Earlier on, I did mention that the Bank of Japan market was expecting the Bank of Japan to actually liberalize and allowing interest rates to rise, in essence, allowing the yield on the Japanese government bonds to rise beyond 0.5%. They did nothing. So the market was actually quite bullish going into the number, and then it came out to be nothing. Okay, so what the market did was market actually reacted to the downside, and then of course there was a bit of a buying back on Friday, but down by and large you can see that the expectation of Bank of Japan to continue to liberalize and maybe even to get out of the negative interest rate policy that they had for so many years since the start of the pandemic. So we can say that this is not working out. But I suspect that eventually they would have to address this issue, because inflation is running away. We can see earlier on when we saw the CPI numbers for Japan, the headline CPI is at 4%. The core inflation is at 3%. So that you can see the inflation is getting out of hand as well in Japan. So the only way they can do to actually tame it is to high interest rates. So there's no two way about it. If you're going to follow classical Keynesian economic theories, they would have to high interest rate. There's no two way about it. So this is what the market is expecting. Okay. Before we go to the currency, let me see if you guys have any question for me. Again, no questions. Very good. Let's continue. Over in currency, now the same thing that caused the Nikkei to go into a spasm on Wednesday is also the same thing that we saw in the currency market. You can see the market was actually trading near the 127.21 before it went spike up to 131.57, or about 400 pips in just hours, okay, because the market did not expect the Bank of Japan to do nothing on the interest rate front. So we can see the dollar actually came back up, because going into this number, into this BOJ announcement, the market was positioning short dollar, buying yen position. So when nothing happened, when the result was announced, all these short positions will have to be unwound. Okay, so the market have a major short squeeze all the way. You can see dollar yen at 131.57 before it came back down again, because after final analysis, they look at, I think the Bank of Japan is trapped. You know, you don't do it this month, you may have to do it next month. Okay, so by and large, the market is still very bearish on the dollar versus the yen. They expect the yen prices to actually benefit from higher interest rates. Okay, because there's a lot of carry trade being done based on the Japanese yen throughout the last 2 decades. Okay, so this is something fundamentally is different this time. Okay. Or over in the euro versus the dollar, we can see the dollar actually rose to 108.87 this week, and it did not close on this close on the high. Now, what happened on Wednesday? Okay, it's also very crucial. You can see this is a reversal bar. Okay, and this bar is actually one of the classical reversal signal, and happening on the daily time frame is significant. So I take this as a selling signal rather than a buy signal, although the market has been going up and is staying very well within the rising channel here. And so far we can see that if you believe this rising channel is where the market should be trading within, then we can notice that the midpoint of this rising channel has not been crossed. You can see all the while from December last year, you can see that every time it come close to this midpoint, the market got rejected. So again, this is no different. If the market go any higher, I suspect that it may not even be able to take out 1.0887 this time. So it would be very interesting to see how market behave in this coming week itself. But I'm already beginning to have a bearish posture for the euro versus the dollar. In fact, I have already becoming more bullish on dollar, because I think the dollar sell-off has been overdone, and it's time for the market to actually see a reversal. Okay, so whether that is the case, we will have to see. Okay, over in Aussie dollars is also the same thing. Although this is not a classic reversal signal, but it is still something that we want to take a note, because the market went up from August low of 0.6168. It has gone up to 0.7063. That is a move of almost what, 900 pips. Okay, so 900 pips over the period of 3 months. This is a little bit extreme. So now we can see the market registered a new high for the last 3 months, and then close week. So this again is a sign, although it is not a classical reversal signal, but this is to me a sign. Okay, so we have to see, although Friday market closed back, managed to claw back near 50% of the entire week's loss, we will have to see whether it has enough momentum to go out and take out 0.7063. Okay. Over in the New Zealand dollars, which is something that I don't cover very regularly, we are seeing a classical reversal signal again on Wednesday. High traded this round since the low in October of 0.55. Market went down to 0.65, a move of 1,000 pips. Okay, so we can see that this move here may have already exhausted itself. Okay, so it could not even take out the December high. Came very close, but did not quite. Did it take out? Let me see. 163. Oh yeah, it did take out. Okay, it did take out the December high, but it did not close above the December high. In fact, we have a reversal signal here right after the high was taken out. So this is to me another key wash trade. Now, what's a wash trade? Market is trying to do a feint move. We saw this kind of feint moves in a lot of sports, especially in basketball as well as in soccer, where the player is trying to feint a move on one direction and instead move quickly to in the other direction. So it is something very similar. So I do foresee that we may have already seen the high for this round. So that reinforced my idea that the dollar may have already bottomed and getting ready to trade higher. Okay. Now over in the sterling, we do not have classical reversal signal. The high traded was 124.36 this week, and it has already crossed beyond the midpoint of this rising channel here. That could be significant, okay? For all we know, because the market has not been able to do that for quite some time. Every time it comes to the midpoint or rejected. But on Wednesday, the market actually managed to cross over and stay above. So this is setting the stage for perhaps maybe a move in favor of the sterling, not so much against the dollar, but against maybe against the euro, against the yen, against the Swiss francs. So we have to see how this sterling cross is going to pan out. Okay. Okay, guys, one more currency pair. Let's look at dollar versus the Canadian dollars. Now, there is no classical reversal here, although there was a very big move here on Wednesday itself. Market peaks at 135.21, but on Friday it lost back a lot of ground. Now, this move here could be very damaging for all we know. So, would it put my bullish outlook for dollar to the knife? It does look the case. Okay, maybe the market will take out 133.21 and go back into this range of prices, okay, to test November low of 132.26. But again, by and large, I do expect over a period of time, maybe the dollar is going to stabilize. But right now, we can't see in dollar CAC for so far. Okay, but the other reversal signals in the euro dollars, is to me a sign of things to come. Okay, I saw it in euro dollar, I saw it in Aussie dollars. So that is telling me that something else is cooking. Okay, I could be wrong. Okay, again, no question on currencies. Are you guys able to respond correctly? Because I'm not seeing any question being posed today. You guys are very quiet. Okay, without much ado, let's continue. Over in energy markets, you can see crude oil prices managed to go up to $82.66 and then stabilize on Wednesday before it pulls back. But by and large, you can see energy prices, as far as crude oil is concerned, is having a very bullish tilt. Okay, the low was traded at $70.02 on December the 9th, but since then the market has done a three-wave rally. So far, the high is $82.66. If this thing continues higher beyond $82.66, it may actually challenge the $87 to $86.97. This is the equality move here. The question here is, can it stay above? Okay, based on what we are seeing, energy markets with the return of China or the reopening of Chinese border, the general wisdom is that that should be supportive of energy prices going forward. So let's see whether this is the case. Okay. Over in natural gas, we still see prices continue to fall. Now, this is getting very interesting. I'm beginning to take a closer look into natural gas. Natural gas is obviously manipulated here, okay? And now the low traded was $3.09, okay? I think we are approaching a point whereby the market will now run the risk of a violent reversal. So if you are trading energy products, do spend some time to track the natural gas, because I believe something major is going to happen that may cause a major violent move to the upside, okay, because the market has been coming down, and so far the market has been very, very bearish. So there is no saying how low it will go, okay, but knowing the situation in Europe, it just does not make sense for natural gas prices to be coming down the way it did, okay. So I do expect some kind of a bottom going to be in place very, very soon. So do watch out for natural gas going forward. Now, gold prices has been on a tear. Gold prices having started the year on a very bullish note at $1,823.53, is now up more than $110 at $1,937.51. Now, this is a market that I have always wanted to buy, but not have been. I have not have the gumption to go in and buy. Okay, and am I going to regret it? It does not look like it's going to come down significantly. Okay, I hope not. Okay, I do want to buy precious metals, especially silver, but prices has been so firm since the start of the year itself. It does look like something major is happening in the precious metal market, and the fact that it's not coming down is a bit of a problematic for me, okay, because I do like to want to have some kind of holdings in precious metals this year going forward, okay. So until it has a pullback, I'm not going to buy at this current price, okay. It does not make sense to me to buy anything northward of $1,900, okay. So over in silver, We're also seeing a bit of a consolidation going on between $24.55 to as low as $23.10. So between this range of prices, market has not broken out yet. And this time around, it doesn't seem that silver is in control. It's more like over the last 3 weeks, we can see that gold has been taking the lead. Okay, last year, leading towards the end of last year, we can see silver was taking the lead relative to gold, meaning to say that silver prices has been more bullish relative to the price of gold. Okay, but this year we've seen a little bit of a change in behavior between these two precious metals. It does look like silver right now is holding water, allowing gold to catch up. So do watch out. And I still would love to buy silver, ideally near the $22 if I can. Okay. So I'm going to the end of this stretch, and let me check if you have any more questions for me. Okay, Sky FX is asking me, I'm just waiting for gold. Okay, technically, the question here is gold still going to go down? Okay, I hope it does, because my overall long-term view of precious metal as a whole is very, very bullish going forward. In fact, now over the last couple of weeks, we have been hearing from commentators and analysts and say the price of gold is going to go northward of $2,400 per ounce. And these are all very bullish outlook. Okay, so I just hope that the market have a chance to come back down a little bit, at least maybe on a technical pullback, allowing me to take a long position. For the time being, there is no sign that it's coming down. That is the sad part. Okay, so I'm just hoping that it can. You make a mistake in gold and bought at 1,898. Why is it a mistake? You close it. that's the reason why you think you make a mistake. So again, anything above 1,900, I really not in. I don't have the stomach to buy gold at above $1,900 per ounce. Okay, I would love to see prices come down to a more sensible level. Not sure what that level will be. I have to wait for the market to tell me how the structure of any pullback is going to look like. Okay, we will have to see. Okay. Okay, somebody is sending me a message. Okay, good. Please do not send me any messages when I'm conducting my webinar, because that will be very, very disruptive for me. Okay. Okay. Now, how about 1,848? If it comes, David, Sky, I'll be very, very happy. But right now, I just cannot tell you that it can happen. Okay. I hope it can happen, but I really have no basis to tell you that it can happen. I was hoping that prices do ease back to a more reasonable level, but that outlook did not pan out. Okay, so I didn't get to buy any. Okay, in fact, going into those numbers, I was actually holding short position. But good thing, I was stopped out with very, very minor losses. Okay, now if there's no more question on precious metal, let me move on to crypto. Crypto is on fire. Okay, now when you look at crypto, we cannot not look at the Bitcoin itself. Bitcoin surged to 23,342 yesterday. Okay, so this is the strongest you have ever been. Is there any basis for that? I think the market is based on the idea that Federal Reserve is going to ease interest rates going forward. So right now, there is two camps. One is do not fight the Fed. Whatever the Fed tells us, the interest rate is going to stay higher for longer. That is one camp. The other camp is say, I don't believe you. Means there's another camp called fight the Fed. And they look at how inflation has been coming down. Okay, and they look at the labor market. It has not caused a major dislocation in the labor market, and they're saying, look, I do not believe the Federal Reserve is going to stay allow interest rate to stay higher for longer. At some point, because when you look at retail sales, we already see retail sales numbers are getting from bad to worse consecutively for November, December, and that will lead to a lower GDP numbers for Q1 of 2023. So they are saying that if this continues for another quarter, the Fed will have to be forced to do a U-turn. Okay, instead of hiking interest rate, they may have to not only cut interest rate, they may even have to launch another round of quantitative easing. So right now it seems that the Fed fight the Fed camp is winning. Okay, so we are based on this idea. You can see that the marketplace are positioning for the eventuality. That's why you see this. Perhaps this is one of the reasons why we see such a massive run up in cryptocurrencies. Okay. I could be wrong, but there is really no fundamental, as far as I can see. Crypto is a relatively new asset class, and there is really no correlation to monetary policy. But we can see this year as equity prices are coming down, Bitcoin and all the other crypto assets has all been coming down. Okay, that could be a correlation. But this year, over the last 3 months, we can see equity prices has been rising, but Bitcoin and all the other major crypto assets has not risen in lockstep with the rise that we saw over the last 3 months since the low in October last year. So maybe this is what we call a Johnny come lately kind of move. Okay, but for all we know, I think this is also belonging to fight the Fed can. Okay, thinking that the Federal Reserve will have no choice but to not only stop hiking interest rate, they may even have to cut interest rates. On top of that, to launch another round of QE. So this is a big call. Okay, I cannot see how this thing is going to pan out for now. You can call the Fed bluff. Okay, but to call for the market to call for the Fed to actually reverse its policy, I think if I'm the Federal Reserve Chairman, I'll be very concerned about having to do U-turn. Just after changing my monetary policy throughout the whole of 2022. Now going to 2023, I want to reverse one more time. Now, who is going to believe me? My credibility will be at stake. Okay, as an institution, I do not want to go into a situation in which every time the market goes into a new situation, I will have to do a major policy reversal. That is bad. Okay, because that would totally destroy their credibility. So I do not believe in fighting the Fed can. Okay, yes, it may appear that they are winning now, but again, we have to face the reality. The US is in danger of not only not able to defeat inflation over the long term, they may also have to face with the idea that the economy is going to weaken. We are really seeing sign of weakness in the economy because retail sales has been coming down and now are in negative territory. So what are we going to do if we're going to get both high inflation, very stubborn prices at the retail level, coupled with weak economic growth? We are going to see a possible stagflation. So this is more problematic for us because recessions are part of the business cycle. They are part of the boom and bust cycle. They come and they go. Okay, but stagflation, if it ever happens, become very sticky and very, very hard to get out of a stagflation. Look no further than Japan. Japan has been in stagflation for more than 2 decades. They have not been able to get out of a stagflation situation. Now inflation is rolling back again, and economic growth has not been stellar, okay, to say the least. And what we're going to have, they've tried everything. Before the world experimented with quantitative easing or even negative interest rates, Bank of Japan has been doing that decades ago. And do they have any result? No result whatsoever. So Einstein says if we put in the same input and expect a different output, okay? If QE and negative interest rates did not work for a major economy like Bank of Japan, now remember Bank of Japan before the rise of China was the world #2 economy, the second largest. They tried it, they experimented with it, okay? At best, they just held, they held the economy from imploding, okay? So that's that is not a policy in which you want to follow. But guess what? The rest of the world has employed a solution that the Bank of Japan has used and has proven to be ineffective. So you tell me what is going on with the world economy? Policymakers are game to try anything, okay? But I think they are not in control. So this is the danger here. If policymakers at central banks have lost control, okay, I think what comes next is going to be just one more major crisis, and everything will go up in smokes because they try everything in the book and then some, and it doesn't seem to work. So this is my fear going forward. Going into 2023, I do expect a lot of volatility. Okay, for all we know, I do expect equity prices to start to fall from here onwards. I do believe, okay, maybe as early as tomorrow. Okay, we want to see whether that
premonition of mine is going to be accurate or not, because I look at how the market has been behaving. I was expecting somewhere between January 16th and 23rd to see a major top in equity prices, and we have really seen the top as of this week. I like to believe that there is a top for this run, and going forward, the risk to the downside is actually, to me, very, very possible. And this slide, if we see one, I'm not likely to see a waterfall move, but I'm thinking at least the top is going to be in place. And if there's going to be any decline, it could continue to decline all the way until the end of Q1 of 2023. Okay, so the next rebound may not come until maybe April or May of this year. So we are going to look at potentially a downward move of maybe 2 months to 3 months. Okay, so this is where I'm going to position myself going forward. Okay, so as far as Ethereum is concerned, we also saw a major run up to $1,680 this yesterday. Market did pull back a little bit, but again, the market now is in that bullish mood. It has, I think the key here is it has already taken out November high. November high is $1,674. Okay, so this yesterday high was $1,680 and almost 80 cents. So it did cross over, but again, you can see that it did not manage to close higher. Okay, so on a close-to-close basis, it has not taken out the last November high. So if the prices continue to ease back this week for whatever reason, then okay, we have to watch how this move develops. I'm not saying that this market has peaked, okay, but I'm not so sure, okay, about this entire move here. Okay, there's simply no rationale why prices needs to rise the way it did. Okay, Ripple is also going high, went higher on Saturday, which is yesterday, at 0.4166, and this is actually supported by this major reversal pattern that we saw at the start of the year itself. You can see this major reversal here on a daily time frame that is underpinning the rise in Ripple. So right now, again, we are getting some kind of news that some kind of verdict is going to be released between the fight between the Security Commission and Ripple Lab, which is the company owning the Ripple blockchain technology. So we're not sure which way is going to go. Okay, but there is the possibility based on technical support here, based on the low at just under 3 cents. There's a possibility that this could be a long-term low here. Okay, over in Cardano has been running again. In fact, this Cardano have a marginal high today. Okay. Cardano is being very, very well supported now as 0.38 cents. Okay, now Cardano has broken out of is about to break out of this long-term trend line here. Okay, if the market managed to cross over and stay above, then it is going to be very bullish development for Cardano. Okay, so again, there could be some kind of news that excite the market the way it did, but I basically look from it from the technical outlook itself. It does look supportive for now. Okay, there's no sign this market is coming down anytime soon, unless of course this overhead resistance here, which has been in place since May of last year, is going to cap this further advances in Cardano. Okay. This other one has been also been on a tear. This one is Solana. Solana has been very much negatively impacted by the collapse in FTX, but it has managed to at least, okay, on paper, okay, actually break the shingle from the shadow of FTX. Now it is coming forward and says that, look, I have nothing to do with FTX, and the prices of their token itself has actually rebounded quite remarkably. Okay, so this is the highest it has been since last month. Okay, so the high traded at $26.57 was actually registered yesterday, and it does look like there is still momentum for the market to go up to maybe $32 going forward. Okay, now I finished what I want to show you. Questions. Okay, Jim is asking, may I know why the interest rate is related to crypto prices? It is not. Okay, I'm still trying to look for some kind of permanent correlation between crypto and the other traditional assets. Last year, we saw a correlation between US equities, in particularly NASDAQ, relative to crypto. Okay, every time NASDAQ took a downfall, we can see that prices in crypto as a whole also went down. So that was a positive correlation. But this year, we don't see the same correlation as the market rebound in equity prices. Crypto did not rebound together with equity prices as what we have seen over the last 3 months. It's only of late that we see the spike in crypto prices. So I have to look for another possible culprit. Okay, in this sense, there is this fight the Fed camp, which is currently marginally winning the fight. Okay, because they do not believe the Federal Reserve can continue to high interest rate for any much longer, and maybe at some point they will have to realize the economy cannot take higher interest rates, and they may have to pivot by cutting interest rates. Okay, so this is that understanding as far as the Federal Reserve action is going to be concerned. And I think the rise in crypto prices, ever since the end of cheap and easy money, remember going into 2022, interest rate was still at 0. Remember that date? Just only 1 year ago, we can see interest rate was at 0. Okay, and then when interest rates start to rise, it also coincides with the collapse in crypto prices. So from that perspective, I do believe that there's some relationship between cheap money and the disappearance of cheap money. Interest rate goes up, the cost of capital went up, and you can see the prices of crypto market has been falling ever since. So now that there is that perception that interest rate may have been near the peak and may be coming down because the Federal Reserve may be forced to cut interest rates, then you can see crypto prices beginning to go up. So they are trading ahead of reality. If that is going to be any kind of correlation in interest rates and the crypto prices here. Okay, so I'm just trying to put one and one together. Right now, there is no obvious correlation between interest rates and crypto prices other than the end of cheap money saw the collapse in crypto prices across the board. Okay, so this is my only connection. David is asking, what will be likely to be the next crisis, in my opinion? Right in my face here, I think will be the debt ceiling. Like I mentioned, the scenario going forward, because we have seen this before. This movie is an old movie. We have seen it many, many times over the last 20 over years, at least for me. Okay, every time there's a debt ceiling crisis, eventually the two parties will, after some kind of horse trading, agree to leave that ceiling. But this time is different, because the new House Speaker do not have the political capital to actually agree with the White House to lift the debt ceiling, because he has been held ransom by 6 of his own party members. Because one of the trade-off in which they have managed to wrestle out of Kevin McCarthy, which is the new House Speaker, is that do not agree to lift or to increase the debt ceiling without a corresponding cut in spending. The White House is saying, no way we're going to cut spending. So how? You cannot agree to with the Democrats and the White House to lift to increase the debt ceiling. On the other hand, the White House is telling you, I'm playing hardball with you, I'm not going to cut spending. So this thing is going to turn out to be ugly. Potentially, the next crisis could be all due to this inability for the two parties to come together to lift the debt ceiling. I must repeat this again. Over the last 20 over years, every time the debt ceiling has been hit, it is always resolved. Yes, there was a period of time whereby during Obama time, okay, beyond the debt ceiling, they went into a suspension whereby civil servants do not get paid. They actually asked to go, okay? But they are not dismissed, just that they say, I can't pay you, don't have to come to work. And if this has, the situation being so different this time, there's a real danger that they cannot come to any kind of agreement, and that would be problematic, because the US has never defaulted before. If we even have a hint that the US cannot raise the debt ceiling and may run the danger of being of defaulting, financial market is not going to wait for the final result. They're just going to react, and the reaction is going to be violent. Okay, so this will be my right at the top of my head, this is one major crisis that can happen. The other one is what's happening in Ukraine. You can see that right now in Europe, they're having a major meeting, and all of them said, I'm going to send you my tanks, I'm going to send you my heavy artilleries. And this is not aiding towards peace. Okay. And just today, okay, Russia has attacked this place called Zaporozhye, I can't remember the name, some Russian name. It's actually where the largest nuclear plant is sited. Okay, so this war can seriously get out of hand. Okay, so if it's not from the economic front, it's going to come from the war front in Ukraine. So if this thing continues to go in the same trajectory, something bad is going to happen. Okay, so we have many crises, flashpoints that are that can actually cause a bonfire. Okay, we will have to watch. Ryan is asking me, what I'm saying is that I believe markets are fighting against the Federal Reserve and that they will cut interest rates soon. However, I feel that they would not cut interest rate anytime soon because they are heading towards a stagflation. Now, the stagflation picture has not come into place yet. I'm just saying that although data such as the CPI, the PPI suggests that US has somehow seen the highest in inflation. Okay. I'm saying over the long term, because the Federal Reserve's goal is to bring inflation down to 2%. I think that would be a pipe dream. Okay. Now it's at 6.5%. To bring it down to 2%, do you know how much interest rate have to go up? It is almost impossible. And for that fact, I do not believe the US economy can survive interest rate at 6%. It simply cannot survive interest rate at 6%. So between not able to bring down inflation to the target rate of 2%, and if inflation continues to stay stubborn at above 6%, and they have to match at least the inflation rate at 6%, it is impossible. So right now, the Fed camp thinking that the Federal Reserve hands will be forced. It's not that the Federal Reserve want to do it. They are putting a very hawkish front. Okay, but this week we see a lot of governor has come in to give their comment, and they did not give us clarity. In fact, they muddled the water even further. The hawks are saying what they need to say. The doves are saying what they want to say, and there's no clarity as to whether come December of February the 1st, where the next FOMC meeting is going to be held, how much of a quantum is the Federal Reserve is going to hike? Is it going to be 0.25%? Is it going to be more than 0.25%? Because the last one was 50 basis points, which is 0.5%. Okay, so most consensus is say that the Federal Reserve come February the 1st is going to hike by 0.25 point. Okay, if that's the case, what's next? The market is looking forward beyond the February 1st FOMC already. So if it come in exactly 0.25, there's no surprise there. Now the question is, what are they going to do after that? Are they going to maintain this level for a long time before they do the next move? The market thinks that it is going to be the case. Because you see, what the Federal Reserve did is very aggressive, okay? But the result will not roll in. There is a lag period of sometime between 6 or 9 months. So they're just going to watch how the data coming in, is it going to be supportive of their thesis? Okay, so we have to see, we really have to see. There's a very good chance after February the 1st, interest rate is going to plateau. How long it's going to plateau? Nobody knows. But whether it will come down, I think that is going to be too far-fetched, okay? Sky is asking, is 2023 going to be like 2008? A lot of people are saying this is going to be worse than 008, okay? Now, the difference here is the crisis in 2008, we are not operating from interest rate, no, we do not have inflation then. In 2008, despite the crisis caused by the Lehman crisis, caused by the subprime crisis, there was no inflation then. This time around, we have high inflation, although the data based on the CPI and the PPI suggests that inflation is coming down, but it's still high, okay? Because depending on how you construct the CPI, a lot of people are saying real CPI on the ground is north of 30%. So when you take this number, compare it to the official headline numbers, There's a big gap in between. Somebody is lying. Okay, so I do not believe the official number reflects the true inflationary picture here. Okay, I subscribe to the scam in which I think at the retail level, people are still experiencing high level of inflation. Now, when you have interest rate as high as it is right now, okay. Now, remember going into 2021 when Biden first came in, he launched a series of stimulus packages in trillions of dollars, practically giving money away for free. This time around, there is no such money coming in from the mailbox. There's no free money coming in, and interest rates are so high. Now, unlike in Singapore, okay, whereby interest on credit card is fixed at 2% a month, 24% a year. In the States, it is a floating rate. So you can see that as interest rate goes up, your credit card interest rate is going to be even higher, okay? And most people has been living on credit cards, and now they have maxed out. That is the reason why we don't see a positive number for retail sales in November and December last year. That is the only logical conclusion. The consumers has maxed out. They have no more places of obtaining credit, and banks are not offering credit. When you see the reverse repo in the repo market, I think I remember mentioning it last week. Okay, a reverse repo is exactly the opposite of the Federal Reserve injecting liquidity into the market. Now the banks have the excess reserve. They don't want to lend to the counterparty. They rather put their money in overnight market with the Federal Reserve to earn safe money. Because why? They don't trust their own counterparty to even lend them overnight. Okay, so if the banks are not even prepared to lend to their peer, there is going to be a shortage of credit. And we all know credit makes the world go round. With no credit, this is a crisis waiting to explode. Okay, so we can expect this tightness in the credit market to eventually cause something to break. And if something breaks, it's going to be a big bang somewhere in the region of Credit Suisse or Deutsche Bank. This will have knock-on effect. The entire house of cards is going to come collapsing. So these are the danger in which we are living in right now. Okay, there are so many flashpoints. Yes, I think it's going to be worse than 2008, honestly. Okay, but why the White House cut spending? Why can't the White House cut spending? If the Americans are physically responsible, they won't be in this situation. There is no government in the States, okay, regardless of who is in control, has been physically responsible. Simply because they can afford to print. Okay. Can you imagine the defense budget is so large? Okay, it's even bigger than the education and all the social spending programs. It's madness. Okay, the US has been going on to spend money they don't have, and they are increasing the budget. I do not understand how any kind of organization. Can you imagine your own family unit? You don't have the income to support such expenditure. Just because you got a credit card that have a very high limit or no limit, for example, okay? And you've been spending like crazy, spending like a drunken crazy soldier. At some point, you will have to face the day of reckoning, right? This is exactly where the US is right now. Okay, it cannot go on spending like there is no tomorrow. So there is no government in the United States that will cut spending. Okay, because they need to buy votes. Okay, it is the way I think democracy is going to die in the States. Okay, so from a Singapore standpoint, how do I think we can profit or protect our money from this coming crisis? First I would do is to get out of paper assets. Any kind of financial assets that are based on paper, be it bond, be it equity, get rid of those. Okay, but if you cannot get rid of those and still want to stay in the paper asset market, at least zero down on those sectors that will do very, very well in an inflationary, stagflationary kind of environment. What do you hold? off the top of my head, I want to hold off to energy companies. Okay, because in the inflation environment, energy companies are going to do well. In a current situation, I want to hold on to resource companies, for example. Although I must say I don't trade equities. Okay, but this will be the logical thing. Get out of financial sector. If you hold on to any kind of bank stocks, you want to get rid of them right now. Okay, this week we saw the earnings from the major banks, JP Morgan, Goldman Sachs, Citibank, they are all underwater. Okay, so get out of those stocks while you still have time. Okay, so I'm not giving you advice. I'm just saying that if I'm in your position, and this is what I would do if I trade equities, but I don't trade equities. Okay, then of course, once you know how to rebalance your portfolio, the next best thing is what will do best in those kind of situations. If tomorrow fiat money, the paper money that we hold in your wallet is going to be useless, the day will come whereby paper money is going to be useless. What asset class is going to be able to replace that? Okay, it is not going to be the RMB or the Chinese yuan. There's a lot of talk that say if US dollar is going to be de-dollarized, the next logical currency should be the RMB, right? Wrong. It's not going to be another paper currency. Okay, it got to be some kind of asset-based currency. The current monetary system that we have globally is based on debt. Okay, and we all know debt has ballooned to such a level, it cannot keep on growing without bursting. At some point, it's going to burst. Okay, what would be the catalyst? Right now, everybody have many theories. Okay, what I'm saying that the date of reckoning is getting very close. You want to hold on to some kind of tangible assets and do not put it in the hands of either the bankers or the government. You want to get out of those. Okay, what is still tangible that is not within the control of governments? Put on your thinking cap. Precious metal is going to be one of them, that's for sure. Okay, so do try to pivot. Okay, protect yourself while you still can, because at some point precious metal will not be available at any price. Now you can still buy. Okay, yes, the price is a bit high right now, but you can still buy. Okay, but there will come a day whereby the collapse in fiat money system collapses, and you will have to go back to either do barter trade or to hold on. The only way you can hold on to some kind of value, okay, to hold on to purchasing power is precious metals. Okay, so I'm a major bull in precious metals. Okay, crisis. Okay, Sky asking, is it might be Bitcoin or gold or silver in the next currency? Like I mentioned, I just give you my response to this. It is unlikely to be another Bitcoin. Okay, Bitcoin is very similar to fiat currency, which is based on nothing. There's no intrinsic value. Okay, I love to trade cryptos, but you have asked me whether it can hold value. It has proven to be unable to hold on to value. The whole of 2022 has told us that cryptocurrencies cannot hold value, so it cannot be a viable currency. Okay, so the world call it cryptocurrency, but I think there's a misnomer here. It shouldn't even be called cryptocurrency. You can just call it crypto, but not currency. It's not a currency, okay, at all. Will there be a recording? I hope so, because I have been receiving notices from Zoom that they have suspended my online recording. Okay, so I have recorded. Not sure where the recording will be cited, or hope it's going to be in my computer. If not, then if they are not allowing me to retrieve it from online, then maybe I will not be able to give you a recording for today. We will have to see. Okay. I think my hard disk space is almost maxed out. Either I increase my hard disk space or I have to get another new computer. So either or. Okay, guys, I have spent quite a bit of time with you guys, and unless you have further questions for me, I think I'm going to call it a day here. I'm currently right now in Batam. I'm coming back tomorrow. So tomorrow morning, I'll be making my way back to Singapore. For those who follow me on my daily market update, tomorrow may be a bit of a delay. Okay, so I hope not. Okay, but it's a possibility, because when I came to Batam, the ferry terminal was overwhelmed. Okay, I've never seen crowd like this. Okay, at the ferry terminal. It was totally chaotic. Okay, so when I came over to Batam, the situation is not much better. So tomorrow I'm going back. I do expect the same crowd that came over to Batam who may be going back to Singapore like me. Okay, so it's probably not the brightest choice of coming to Batam. Okay, but it could happen. Okay, okay. Sky is asking. Okay, okay. Max is asking. Oh, thank you very much, Max. I will try to be safe. I have my family with me. I need to be safe. So David is asking, that shows the recession may not have much impact. Now, I'm not saying that. I say we're going to have the worst of both worlds. We're going to have elevated prices coupled with slower economic growth. Okay, recession is not a problem. We have blown up the impact of a recession. Recessions are very normal. It's part of the business cycle. You want to enjoy the upswing, you must also be prepared to take the downswing. Okay, it's the business cycle. So recession is not to be feared. Don't try to avoid it, because the central bankers have been trying to avoid recession, and they are trying to smooth out the business cycle. The more they do, the more damage they are doing, because the damage they will do, okay, is going to be more permanent. Okay, what I'm more concerned is that we're going to get a worst of both worlds. Elevated prices and slow economic growth, which lead to a more sticky situation in which you're going to get stagflation. Okay, like I said, stagflation is very, very sticky. It's very hard to get out of stagflation. Ask the Japanese, they know that. Okay, okay, guys. I hope I can give you the recording. So Dennis is asking, dollar may go up, meaning gold prices may retrace back. Yes, if the dollar goes up, which I think it may, okay, then obviously that will give me a chance for precious metal prices to come back down. But this is the normal correlation. Do prepare for a situation in which the dollar goes up, gold may go up together with it. There is no fixed and hard rule. They say that just because dollar is going up, precious metal must come down. It is not always the case. There are cases in which I've seen, okay, in which normal correlation do not work. Okay, then you'll be scratching your head. How come? Based on past correlation, this is how the mechanics works. But there are times whereby the mechanics don't work. Correlation can change. What I'm saying that I do hope prices of precious metal come down as the dollar rebound. Okay, we will have to see whether it does so or not. But there's no guarantee that it will. Okay. Okay, guys, really, I have to go, and I will see you again, if not on Monday, which I have my regular Monday update. Then I will see you next Sunday in Singapore. In the meantime, 恭喜發財. Hopefully this year the rabbit will be good for all of us. Just be prepared for volatility and make sure you position yourself correctly. Okay, guys, I'll see you when I see you. Bye-bye.